Have you been told that you need 20% down to be able to buy a home? It is completely false. There are so many other options that we're going to be discussing today. So that way, and you're better prepared to figure out what's best for you. NerdWallet came out with a study in February of 2025 and said that 62% of Americans still today thought that they needed 20% down. Some of the things that we're going to be talking about is down payment assistances and how down payment assistances are not just for first-time home buyers. Not all of them have income limits. So they actually give you more options to bring less money down. Before, I'm a bilingual mortgage broker and my team is licensed in over 40 states. I help families, Spanish-speaking, first-time home buyers, veterans, all being able to educate them about the process of homeownership, how to buy a home with not the best credit and also not with a large down payment. When you're ready to make your next move or really just want to get some answers to those many questions that you have, go to callmortgagelist.com. Let's schedule a time to figure out what options are best suited for you. Going over some basic programs, if you look at FHA loans require a minimum of 3.5% down if you have a 580 credit score. If you have a 100 to a 579 credit score, they do require a larger down payment at 10%. While they still give you options where conventional loans don't give you as many options in that credit score bracket. As a conventional loan, majority of Fannie Mae and Freddie Mac programs will require a 3% down payment, but the 3% down payment comes with the caveat that you have to be a first-time home buyer. There are some programs from different investors and lenders that will allow you to do as little as 1% down, but it depends on your income, depends on the area, depends on what you're trying to purchase, because all of those programs have additional restrictions and requirements that you have to meet to be able to determine which one is going to best work. Because sometimes Fannie Mae's program doesn't work because Freddie Mac is actually better suited for your situation. 100% certificate of eligibility, meaning you are full entitlement to purchase your home. You can actually do that with 100% financing and you don't need any money down. The best part about that is that you can actually reuse that entitlement to buy your second or even third home, meaning you can have multiple loans on that one entitlement. If you sold your home and wanted to buy a new one, you could reuse that same VA eligibility as long as you still have it. Always remember that as a veteran that has been in the service, depending on what kind of service you've been, will depend on the type of paperwork that you actually need. So before anything, when looking for a new home, make sure you pull your certificate of eligibility that confirms you are fully eligible. Unfortunately, I did run into a situation with a client where they had multiple VA loans in the past. When they went to get their next VA loan, they said they were not eligible because the VA had made a mistake and they weren't supposed to be eligible in the first place. So always make sure that you get your certificate of eligibility in hand before you start going out talking to lenders or even writing offers. Next option would be a USDA loan. USDA loan is a little bit more specific to the area that you're trying to buy. Now, so a rural area doesn't mean that it's rural today. It means that based on the most recent reports that were done, that at that time, your area that you're trying to purchase is classified under a USDA as eligible. Now, the detail that you got to remember is a USDA loan is very different. It has income limit. It has a very restrictive debt to income. So that means that you can't spend as much as you would typically spend on an FHA loan, and they want you to have a lot less debt. So while it is a great program, it is not for everyone. It does do 100% financing, but it does have income limit. So it's a little food for thought as you're trying to figure out which program best fits. Let's talk about my favorite topic. Down payment assistances can be connected to multiple different programs. Meaning, if you get down payment assistance and you get one and you want to use it with your FHA loan, you can do that. Majority of programs actually connect them to FHA. There actually is even some additional assistances that can be connected to a VA loan. So why exactly would you need a down payment assistance? Well, if you don't have the money to cover the closing costs and the seller says, absolutely not, I'm not giving you any money. Also remember that not all down payment assistances will allow you to use them for closing costs. So again, that's back to the lender, making sure that whatever you're trying to do is going to be allowed in the way that you're trying to do it. About down payment assistance is that not all programs are the same. Depending on whether you go to the city, the county, the state, or you just use the program that is associated to that lender, you can have really different requirements. So if you go to the state of California, CalHFA, you will find that they have a very lenient income amount. You still have a restrictive amount as to what you can spend on a monthly basis. Typically, you're looking at about 45% of your income. If you have a higher credit score, you can go up to 50% of your income. So what does that actually mean? If you make $1,000, you can spend up to $450 on the mortgage payment plus your bills based on the typical program for CalHFA. Keep in mind that the rates publicized on calhfa.ca.gov are not the interest rates with the correct closing costs. So they are just the par rates, which means that they do not pay out your lender. You can go to any lender that you choose. They will all have the exact same interest rates, but the closing costs are going to be different because every lender has to make their money and get paid. The rates on that website do not include those actual payments to the lenders. So you will have higher overall closing costs comparing that to other programs. There are other programs that give you that 5% in assistance. You can do a portion of that where they do 3% and it's a forgiven grant. The rate is going to be higher, but it's forgiven money. Then there's some programs that do 5%. It's repayable money. So you got to pay it back every single month. It's allowing you to get into a home that you wouldn't have been able to get into because you don't have the money. So down payment assistances are not for everyone, but they do work when you financially need them. So remember, down payment is their own bucket, depending on where you are financially, what you're trying to buy, the city, state, county, the type of house, your credit score taken into to figure out which program is best suited for you. All right. So how much is 20% down payment anyways? So if you're trying to buy a home at $500,000, 20% would be $100,000. But if you were doing an FHA loan, 3.5% down is a lot less than $100,000. Then you'd look at the 1%, which would be $5,000. Or if you did 3%, which is what some of the programs under conventional financing do, you're looking at $15,000. So it does give you some different options to see how much money you actually have. Don't forget that when you buy a home, you have to pay for the down payment and the closing costs. Depending on like how much the seller is going to give you will depend on how much the out of pocket would be for you. If the closing costs are partially paid by the seller, you have less to come up with. To do these programs, you don't need a high credit score requirement. There are plenty of programs that require a 600, a 620, a 640 credit score. Being a mortgage broker, there are plenty of different mortgage lenders with plenty of different guidelines that best suits where you're currently at. So before you go back to the bank to figure out whether they can actually do your loan because you think that they're going to give you the best interest rate, check out other institutions. Check out other options because it's very possible that they have other options that the bank doesn't. And it's always great to get multiple options as to what you're trying to do. And remember, you do not need to run your credit at every single mortgage lender. Any mortgage lender can definitely run your numbers just off the math because math will always be math. 1 + 1 will always equal 2. If they're looking at your income and then roughly what your debts are, you should be able to figure out how much you can qualify. You can do that based on conventional financing, FHA, VA financing to figure out where you actually will end up. Now, how much do you need to make to buy a home today? Well, that depends on where you're looking. If you are in California and you're trying to buy a home in San Bernardino, Bakersfield, San Diego, or Riverside County, or if you're trying to buy a home in North Carolina or Indiana, these are all completely different markets with completely different purchase prices. So somebody that wants to live in Bakersfield will not need to make as much money to buy a home that's almost identical to what it would be in San Diego County. Now, while we're talking about the down payment assistance and closing costs, how much do you really need to estimate when it comes to buying home? Let's not forget the appraisal, the credit report, if that lender's charging it to you. The area that you're looking at will depend on those additional costs. You could potentially be looking at thousands of dollars. That depends on how much you'll need in your bank account before you find your home, before you get your keys. Your appraisal could be $500 to $700, maybe even more, depending on the area that you are in. Okay? Then you have a physical inspection. A physical inspection can run you anywhere between $300 to $600, maybe higher, maybe lower, again, depending on the area. Let's not forget about the credit report because some lenders are charging for the credit report for them to actually do their pre-approval or more so just to run their credit. So keep that in mind. And credit reports have gotten up way higher than when I used to do loans back in 2009 and 2010. I mean, during that time, credit reports used to be $30 and $60 and $70. Today, a credit report for one individual is over $200. So keep in mind that there are lenders that will charge that to you up front before actually running your credit. Other things that you can anticipate is a termite inspection. There are other inspections such as a structural engineering and a foundation report if you're buying a manufactured home, which could run you an additional $400 to $600. All of those pieces all depend on the type of property that you're doing, the area that you're trying to buy, and the type of loan and the lender who you're actually working. Now, where can your money actually come from when it comes to the down payment and the closing costs and all of these fees that come along with it? Well, the money can come from a gift. So from your family member, they can give you money and not loan you money because that's a whole different ballgame. Now, they can give you money to help you with this down payment, the closing cost, being able to pay for these additional expenses. That is an option that you can actually do. Or you can obtain the money from a 401k. I do not recommend you doing a hardship. You don't get taxed with a penalty, but you still have to pay for the federal and the state. Now, I am not a CPA. I am not an accountant, but those are basics that you should know as a lender. That in fact, if you do take money as a hardship, you do have to pay additional money out of that money. You took out $50,000 for your purposes of your down payment. Well, you're not going to see all $50,000. And even if you saw $50,000 today, next year when you file your tax returns, they're going to require that you pay the taxes or the penalties or whatever is you're subject to. So what I would recommend doing is using a 401k. Most 401ks allow you to be able to take money out. They do it for a short time, 3, 5 years. They even do it to a 10-year loan. I don't recommend a 10-year loan because that means you're taking your money off the market to make you money for your finances. If you take the money out as a 401k, it literally gives you a loan where you are the person that is receiving the interest. So you are paying yourself back that interest. So you took out the $50,000 and then you're paying yourself back the interest, whatever your company has set up. And by the end of that type of loan, whether it's 3, 4, 5, 7, 10 years, you will end up getting all of your money back. So it's not a one shot where you take the money out and then now you're getting penalized. And when you're ready to make that next step to review your options to buy your next home, we are licensed in over 40 states. Go to callmortgageliz.com. We would love to be of service to you and your family to find your next home loan.